Dave Nadig, Director of Research at ETF Trends. Dave, thanks for being here with us. Obviously, ETFs and inflows have been just incredible of late. So let's start with this hot topic of 2021, and it's inflation, right? And so when you see these trends, tell me how inflation and ETFs could be related.
Well, we just saw these ISM manufacturing numbers. That's really been the kind of story we're seeing. It's these supply constraints that are starting to drive up core prices. We all know the story in lumber. It's up about 80% this year, but it's not just lumber. You look across the board, we've got 25% up in oil, 25% up in copper, 25% up in corn. Like, it's pretty much everywhere. And so what we're seeing is a lot of investors and advisors are looking to commodities plays to help them play that space. They think that's probably a better call than something like tips, which frankly are a little played out at this point. The moral of the story with tips has always been, by the time you think about it, it's probably too late to get in. So the commodities angle has really been what's been working. We've seen a bunch of flows into PDBC, that's the Invesco optimum yield sort of broad commodities basket. It's pulled in about $1.5 billion so far this year, which is pretty good for commodities, honestly. The challenge there is it's super concentrated in energy. If you're not a big believer in traditional petroleum-based energy, it's tough to love these big old commodities indexed approaches. I think I like DBA, which is the agriculture fund, a little bit better. This is really just giving you exposure to corn, soy, sugar, wheat, coffee, all things that we buy in the grocery store, all things we've seen the prices go up on. PDBC is up about 22% this year. DBA is up about 14%, but I think it's probably got a lot more of a tailwind going. That's probably the magic button for inflation.
Okay. So good areas to watch as you talk about inflation and how it affects names we could watch in this group. I like the ag call. That's an interesting one. What about when we look at, as far as equities go, and we're talking about technology, that's been a dominant force, right, over the last 10 years. ARK ETF has been something people follow. Now what?
Yeah, I think the bloom is off the rose on some of these very high beta, high growth plays. We've seen a lot of folks in the equity space sticking to equities, but really trying to risk off. And the way you do that in equities is by looking at things like traditional value or dividends, or even branching out into things like real estate that may give you some diversification and a little bit of income. So we like all of those plays right now. I think that intra-equity rotation is going to be with us for a while. We're starting to see a lot more interest in things like mid caps as well. So I think those are really the core. If you look at the last 4 months of flows, the big surprise winner has really been Vanguard's VTV, which is just a straight old value fund. It's not particularly exciting, but I think investors are really looking for a little bit of safety while still trying to stay invested, and that can be pretty tricky.
I know, sometimes investing is boring. But that's the way to make some money, right? It's not like these hot trends and just trying to go for some value or some dividend payers or things like that. Thematic investing, Dave, as you know, is an area, something that we never talked about 10 years ago as far as ETF trends, but now there's an ETF for just about every particular trend. ESG has been one that a lot of people talk about. What trends are you seeing in the ETFs related at least to ESG and whatever else you want to add in?
Sure. ESG has certainly been a huge topic of conversation, if it's not just at the water cooler, in every advisor's office. The challenge is a lot of the new products we're seeing in the ESG space are pretty hard to distinguish from the non-ESG funds. We just saw one of the largest launches ever in iShares Carbon Transition Readiness ETF, that's LCTU, launched on day one with $1.25 billion from the California Teachers Retirement System. So clearly a big player wants to be in this fund. But if you look under the hood, what you see is Apple, Microsoft, Amazon, Google, Facebook. Looks a lot like what you'd see at the top of the Qs, looks a lot like what you'd see at the top of any sort of US large cap or large cap growth fund. And I think that's a bit of the challenge. People want to feel good about their investing. They want some of that ESG, but at the same time, they don't want to abandon their benchmarks entirely. That's sort of the battle we're seeing in ESG right now. How do you be ESG but still stay basically market weight? that's a real challenge. But that's where most of the assets have been going, into what I would call these fairly watered down approaches to ESG. They sort of check the box for ESG without straying too far afield. That seems to be what investors want.
Right, I see what you mean. I see. And I thought it was funny when you said the bloom is off the rose when it came to tech. What are you going to say about bonds? When we look at fixed income and the kind of flows that you're seeing related to bond ETFs.
Yeah, it's pretty straightforward. Investors don't want to have anything to do with long bonds. We've been in just sort of continuous outflows at the long end of the curve. There has been some of that rotating into the very short end of the curve, but the story is pretty clear. People are either getting out of bonds, or if they're staying in bonds, they're sticking to very short duration, and they're really hunting for yield, right? Those folks that are allocating into bonds consistently aren't just buying 3 to 5 year treasuries. They're looking for investment grade. They're looking for high yield. We've seen big flows there. We had about $7 billion come into corporates just in April, about 50-50 investment grade and high yield. But it's all stay short, look for spread. That's everything we're seeing in the bond space. Real tough to love it going forward for all the obvious reasons. So we've seen the flows really be about 5-to-1 equity to bond so far this year. I don't think that's going to change in the foreseeable future.
When you look at 6 to 12 months out and what you've been seeing in fund flows, I mean, we know that ETFs have been so incredibly popular. Do you think the trend of investing in ETFs is now here to stay?
Yeah, and certainly anything that we've seen from the Biden administration around taxes is only going to accelerate this, right? ETFs kind of got put on the board because of their tax efficiency. Of the 600 and some odd ETFs tracking the equity market here in the US, only 3 paid out any capital gains distributions last year at all, and they were very de minimis. It's about half of the mutual fund side of things. So I suspect what you'll see as this prospect of higher taxes, higher capital gains taxes becomes a little more real. We're going to see a lot of investors booking those gains in their perhaps mutual funds, their actively managed mutual funds they've been hanging on to for a while, or even in their single stock positions, and rotating that money into ETFs because the ETFs are going to give them a better long-term tax situation. So I don't think that trend's going to go anywhere soon. I think we'll have a Bitcoin ETF by the end of the year. And I think it's Katie bar the door. I don't think that anything's going to stop the ETF train.
All right, Dave Nadig, always great to have you on the show. Thank you so much. Nice breakdown there of ETF trends. Dave Nadig, thanks.
Thanks for having me.